Hi everyone, my name's Will. I have to say, I think I've started the world's most obscure investing and finance podcast, the Geospatial Investor. I still think some of the things I'm going to show you today are incredibly exciting and interesting, and they make society better. So let's start with an example. 27th of March 2020, so peak of the COVID panic. One of the most famous hedge fund managers in the world, Bill Ackman, founder of Pershing Square Capital, he retweeted this.
We wanted to see the true footprint social gatherings like spring break beach crowds could really have on our society in the face of a global pandemic. To do so, we started with the big picture, powering our engine with billions of anonymized location data points from mobile devices across the globe. Using tectonics, we can then zoom in on specific regions. Here, we focus specifically on just one beach in Fort Lauderdale during the month of March. Again, each of these data points shown on the map corresponds to a unique mobile device active on a given day. You can see clearly that device activity spikes during the 2-week stretch of early to mid-March, corresponding with spring break. No surprise. Now, using an analysis called a spider query, we can actually track movement of these devices over the remaining weeks of March, seeing where these devices went after spring breakers left the beach. As we zoom further and further out, it becomes clear just how massive the potential impact just one single beach gathering can have in spreading this virus across our nation. It can be hard for us to realize sometimes just how connected our world really is, until the data tells the stories that we just can't see.
All right, so there were a few things going on here. Let me mute it and let's start it again, but with a bit of commentary from yours truly. So let's just stop here. Top right, it's telling us that there were 13 billion records at the planet level that this dashboard or the database that's behind the dashboard ultimately contains. That's a hell of a lot. Let's have a look at the components of the dashboard. So we've got a map. We've got some numbers. You'll see later on that they all respond to the state of the map. We've got some other cards or panels on this dashboard. The bottom and the bottom right are underneath my video. So let's just skip forward a bit. So you can see as I drag forward, the numbers are changing depending on what's in the map. So are the charts. Let's go all the way. He said that he found, he drew a lasso around a bunch of people on a beach in Florida. So let's skip forward. I think it was 45 seconds. There we go. So we can see here that he has selected 5,600 individual cell phones on this beach. So why I'm excited about this industry, the geospatial industry, is what happens from this point forward. How a tool from this industry permits humanity to see the spread of something geographically, something that's incredibly meaningful to humanity. You know, the latest, most significant pandemic since the Spanish flu 100 years ago. And a country, the US, is seeing what's happening to itself as a result of this tool from just 5,600 cell phones on a beach in Florida, and how that propagates, using those cell phones as a proxy for people. So essentially how those people propagated from that beach across the country. So that's why this guy, Bill Ackman, who controls billions of dollars in his hedge fund, so a guy with a bit of responsibility, let's say, and who needs to be on top of things. He needs to have a sharp mind. He needs to pay attention to useful tools. And so that's why this guy, said this is pretty frightening. And someone like that, he needs to pay attention to the state of things. And it's really interesting to see that someone like this is using a tool like this, or is paying attention to the messages that a tool like this delivers. Continuing the COVID-19 theme and what how the geospatial industry responded to it, or how humanity called on this industry and this discipline. We can look at maybe a dashboard that you're more familiar with. It was basically in the news somewhere on the planet, throughout the day for a year in 2020. So here again, we have a dashboard and we have a map. We have a bunch of panels and numbers, and you can also zoom and pan the map. You can go down, to France. You can click on it. Cases in the last 28 days. Can you believe even now it's still 2.5 million? What happens if we click here? Oh, hello, suddenly numbers on these panels are changing again. We can zoom in. Oh, that's not terribly useful, is it? But you get the feel for how this sort of dynamic dashboard answers questions about a really important topic for humanity. All right. So this is a brief, hopefully attention-grabbing introduction to the geospatial industry. It's my profession. I've been doing it for 12 years now. But why on earth am I starting a podcast, especially at 11:40 p.m. on a weeknight? Why have I suddenly decided it's time to start a podcast about this, especially the investing and finance aspects of the geospatial industry? Well, there's a quote that I found. Again, you can see I'm a bit of a Twitter addict. So let's have a look at this quote, and I can zoom in a bit too for the people who are blind like me. So I'll try and read this quote in an upbeat, dynamic fashion so you don't get bored. It's difficult to get rich on a salary. This is because you get paid linearly for analyzing and solving a given problem on a job. But you get paid in an exponential manner for spotting and seizing opportunities as an investor, a venture capitalist, or an entrepreneur. So the first thing that springs to mind for me is that I've been a professional. You can see how I'm dressed like one. Funnily enough, we spend very little time dressed like this in my industry. It's only during an interview, and especially for a job that I'm especially wanting to get. The rest of the time, we're dressed in t-shirts and shorts. Well, maybe jeans. But the thing to think about here is that all of us diligent professionals who are getting paid salaries, we are paid by the other guys in this quote, the ones who are called investors, venture capitalists, or entrepreneurs. And as the quote says, the ones that are receiving an exponential payoff are not us. They're not the ones wearing the ties. They're not the ones who are getting paid a salary and who are doing fantastic work to produce, for example, this dashboard, or either of these dashboards. There's nothing against the incredible work that we do as professionals, but at the same time, it pays to literally to pay attention to who is really getting paid. There's a sentence for you. As I said, it's 1:45 here. I'm doing my best to hold it together. So this made me think a little bit. Because I've been in the first sentence. I've been one of those people since 2011. When I started in Australia. I'm in the UK now. I've managed to use my degree as a bit of a passport, really, to go across the world, and I'm proud of that. And I've had a fantastic time. I have no complaints about the experiences that this industry has given me. It's been incredible. It's been heartbreaking. It's been tragic. It's been eye-opening. I've started a family along the way. I've met the love of my life. Have been the definition of ups and downs along the way in the different countries I've been to. But I just can't get this out of my mind, that I might not be getting everything I can from this industry. So let's explore this concept a little bit of exponential, this word exponential. Other words that are sort of the same are compounding, Maybe you've heard of the idea of compound growth or interest. That also is sort of along the same lines, compound interest, things like that. So I've got some more, of course, you know I'm a Twitter addict by now. So I've got some more tweets that are on this subject. So there's a guy that in investing circles you would have heard of if you're already if you play in those circles or through this podcast. I mean, I'm not going to obsess about him, but a lot of other podcasts do. So Charlie Munger, there's a quote from him. The first rule of compounding is to never interrupt it unnecessarily. So we've got a little graphic here. It's got a curve on it, or a bunch of interrupted curves. So there's a small curves and they stop and they go and they start again. But then you've got the one on the right, which is not interrupted. It's what all of these could have become. So that's an interesting idea, you know, that it's basically saying that if you let something run its course, this thing called compounding, over a period of time, you know, you let it play out over time, then, you know, it starts off looking pretty boring and inconsequential, you know, all of these ones. You know, you could probably understand why someone lost patience and, you know, if this was money that was compounding, you know, they got bored and they went and spent what money they got to at this point. So it does spend a bit of time not doing anything. But then very quickly it starts to go up and up. But you need to give it time to get to that point. So these are some initial observations about this word exponential in the second sentence of this quote. But there's more, of course, on Twitter. There's this guy Brian Feroldi. He seems to be pretty diligent. He puts out a bunch of good content, and he really goes to town on concepts like this latest one. And it's more focused on investing. So I said this is the Geospatial Investor podcast. I appreciate that most of the people that come across this podcast, they're going to be, you know, from friends of mine in the geospatial industry. I reckon a good bunch of you already know about investing and have taken an interest in it. I mean, the analytical side, we're all sort of analysts at heart, and we all love to come up with a systematic approach and apply it to something. And I wouldn't blame a lot of us for having spent until 3 a.m. at night on a spreadsheet analyzing a business. But a good portion of you probably haven't. And the idea of investing, you know, there's probably a bunch of baggage that comes with it. You might think that it's unethical. You might think that the people who do it are really gambling. Also, you might not be aware, as Brian points out here, that there's lots of different asset classes or different things that you can invest in. And if you pay attention to it, to this chart, you'll see it starts in 1802 on the left, and it ends pretty much now. So that's a really nice long sample, isn't it? You know, we're all scientists, so we like the idea of a decent sample before we begin to trust something. I know that I am. I'm a pretty skeptical guy. So let's look at what happens to the dollar if you bought dollars. Well, if you started with $1 200 years ago, you wouldn't have much left by now. You'd have basically 5 cents. So obviously it's not a good idea, if you trust this chart, to hold on to just have your money in cash. Now, another one that a lot of people talk about is gold. And, you know, you hear people saying, oh, you know, don't trust the bank. You know, don't invest your money, you'll lose it all. You know, just buy gold. You know, gold never goes out of fashion. It's been around for thousands of years, and that's true. And what's also true is that it's better than holding cash. You would have turned $1 into $3.20 to be exact, over 200 years if you'd held on to gold. So as I said, it's better than holding cash. But it looks like on this chart that there's some other options. So let's go through those. Treasury bills and bonds, they also seem to do, you know, relatively well. I mean, you know, it's certainly better than the 5 cents that you end up with. But, you know, still, I'm seeing another line on the chart. You know, I can't keep my eye off it. So let's go up to stocks. Stocks or shares, part ownership of a business. Well, look at that. I mean, you know, compared to just holding cash, where you end up with 5 cents after 200 years, on average, If you put it in the stock market, in something called an index fund, it looks like here, you'll end up with 6.7% growth every year for 200 years, which turns $1 into $931,000. So I guess you're thinking, cool, wow. I mean, I guess there's many responses. Probably a bunch of you, given that we're all skeptics and we're all scientists at heart, you're probably not convinced and you want to see more. But I'm guessing a few of you at least are a little bit interested. But a bunch of you that are also interested are probably paying attention and thinking, well, that's still there's this greedy guy in front of me with a strange foreign accent. I'm not supposed to be a greedy person. I'm supposed to be virtuous. But please bear with me. I'll see if I can convince you to by the end. God, there's so much detail in this tweet. I will put it in the show notes, and you can go through it and get all the detail yourselves. What's some other things I can pull out of this? I mean, we were talking about compounding, right? So let's go to a tweet at the end, just to continue with the compounding theme. Then I'll come back to this one. So let's look at compounding again. We were looking at the time in the first chart, 200 years. So let's also look at a long stretch of time. So let's say that you started investing when you were 20, or rather, more importantly, you started compounding when you were 20. So what this chart is trying to illustrate is the same kind of concept. So if you had $1 when you were 20, and you left it until you were 65, and you let that dollar compound until you're 65 in the market, then you would that dollar would turn into $18 by the time you were 65. So a way to think about this is that when you're 20, sorry, did I say 18? Then I meant 20. Usually I think about this sort of chart in terms of starting from 18 until retirement, 65, 47 years in total. This one starts at 20. It's fine. So, oh, okay, it's $18 there. As I said, I'm tired. I'll try and get all these points out and remain coherent, and then finish for the night. So the main point is that if you had $1 when you were 20 and you left it compounding as an investment until you're 65, that dollar would turn into $18. Another way to think about this is that every dollar in your pocket when you're 20 is actually worth $18 if you apply the effects of time and compounding. And, as was said in this tweet, you don't interrupt the compounding. So let's go up the chart a bit more. I mean, I'm currently 38. So every dollar in my pocket is worth 3 times less. It's worth a measly just shy of $6. So I hope that's starting to bring the message home for you, and it's a serious matter. If you don't invest at the beginning, I keep saying investing because I think compounding and investing to me are interchangeable. But let's keep it on the compounding topic and use that term. So if you don't start compounding in the green zone in your 20s in a serious way, you miss the chance of having dollars in your pocket that are worth a serious multiple of that single dollar. By the time you're 31, I guess here, it's come down below $10. So it's almost as though if you just get your compounding done in your 20s and then you forget about it for the rest of your life, you'll still end up with a significant sum. If you start late, when you're 50, it's almost not worth it. You almost won't see any effect really of compounding. So that's an important message, I think. That's a really nice way to illustrate this compounding concept that, as was said in this quote, some people, but not all people, namely the investors, venture capitalists, and entrepreneurs, they're the ones benefiting from this exponential function. I, as a salary earner, I'm not in that group. I'm not benefiting from exponential growth. I'm getting a linear growth. Linear growth from attending lots of courses and improving my skills and getting experience, so I get pay rises. Or just sitting there and essentially leaving my wage to increase, at least with inflation. It's nothing like the exponential growth that you can get. Okay, good. So I said I would just do one more image from Brian's tweet storm here. So it's about innovation. So we've got a bunch of different types of innovation that have driven returns, and that you as an investor or as someone who wants to benefit from compounding, put it that way, you might want to pay attention to. Might is the operative word there. I'm not into hype. I don't want to send everybody down the blockchain path and all of that, even though blockchain's on this somewhere on this this image. But I wanted to point out that 3D mapping, 3D data sets, for example, augmented reality, you can kind of relate that in fact, you can totally relate that to the geospatial industry. So there's three that relate to this industry that have been identified as important to pay attention to, sources of disruption in how the world works, which can be a good basis for making investments. I'm sure there are some others. I know that geospatial has a lot to do with real estate. All the real estate websites these days basically use a map as an interface, just like you saw in that dashboard about the first dashboard about people with COVID on the beach. So yeah, I think this is another. We're starting to see. I'm starting to go. We've introduced you to exponential growth and compounding. And now we're starting to link it into the geospatial industry, and you can see why I'll now talk about the basis for linking geospatial and finance or geospatial and investing. What I've done is I've simply put into Google geospatial industry growth rate or market growth rate. And I've got a bunch of reports back. We've got an interesting term here, CAGR, which means compound annual growth rate. It's the same. It's just a way of a fancier term for compounding in a financial context. So the first one is fairly pessimistic. It's saying that they expect a compound annual growth rate of basically 5% until 2028, it seems. So let's have a look at some of the other ones. So they've given a CAGR of 7%. That's a bit more optimistic. You will recall that if we go to the top of Brian's list, you'll recall that over a 200-year stretch, the stock market, in aggregate, achieved 6.7% compounding rate. So already the second least pessimistic assessment of the growth of the geospatial industry is above the 200-year market average, 7.2%. Okay, so there's some more though. There's four more that have wildly more optimistic predictions. So until 2028, this one is saying the expected growth rate of 12.8%. Wow, that's double the market rate. These guys are saying 12.7%. These guys, what are they saying? There we go, 13%. So really getting up there now. And so that's for the geospatial industry as a whole. That's pretty incredible. Double the compounding rate of the market just for one industry. There's an interesting British, Richard Koch is his name, and he's written a few business books. It's like the 80-20 principle, but there's another one called the STAR principle. In a nutshell, what the STAR principle is that you want what's called a blue ocean as a business person. You want you want to avoid a red ocean. A red ocean is filled with other sharks and other creatures, and you have to fight them, creating a red ocean as you fight them for customers and market share. And it's a race to the bottom. It's all about efficiencies and scale. And it's not really exciting. It's all about attrition. It's run by committees. What you want instead is a blue ocean when nobody else has discovered. It's what Richard Koch calls a star business because it's a niche that either you've invented yourself or that you've come to dominate by beating the other competitors. There's the aspect of it being a niche for a star business, but also that niche has to be growing fast enough. So it has to be growing at least 10% per year for it to be a star business. So you need to be dominating a fast growing niche. Cool. So that's interesting. So we've looked at geospatial, which you could call a niche, but there's a lot of different businesses in that niche. We'll have a look at those in a sec. So I wouldn't say that it was a blue ocean in any way whatsoever, but there can be niches within the niche, if you like, or niches within the geospatial industry. And one of those that's a bit more popular, and maybe some of the people who are watching this or listening to this podcast who aren't from the geospatial industry, they might even have heard of it. So 3D models of cities. So when you go into Google Maps and you change the view to 3D building view, you can see essentially fancy rectangular volumes of simplified buildings. So this is a 3D model of a city. Also, both Apple Maps and Google Maps have a 3D model of even down to the trees in the satellite imagery view. So I think it's in the popular consciousness as well, this idea of 3D city models. So this particular niche of the geospatial industry is growing much faster than the industry itself. It's growing, according to this report, at 17.2%. I also found another one from the hilarious name Mordor Intelligence. I love them for coming up with that name. They said until 2028 they're expecting that niche to grow at 21% per annum. This is incredible now. This is more than 3 times more than the 200-year market average compounding rate. So now we're starting to the likes of Bill Ackman, this one of the world's most famous, if not the most famous hedge fund manager, he would be paying attention to these sorts of growth rates, and so should you, my dear obscure geospatial industry audience. So should you, as someone earning just a salary, potentially, hopefully not all of you, but I'd say the majority of you, so should all of you who would know that your salary has certainly not been increasing at 21% per annum, right? But the great thing about being in this industry and being an employee of any of these businesses, big or small within it, and the smaller the better in some ways, is that you have an ear to the ground all the time. You know all of the businesses, all of the people, all of the clients. You have a great chance to spot these sorts of niches within the industry that are growing really quickly. And you're uniquely positioned because of your technical knowledge and experience to assess which of the competitors in that niche is most likely to dominate it, and extract that compounding rate, and provide you potentially the benefit of that compounding rate as a shareholder. So I know that's a lot. It's a big message to deliver. Excuse me, I really am an amateur podcaster. I really didn't come prepared with some water. Or enough water, I should say. But I know that we've gone from trying to dazzle, especially the civilians to out there, the non-geospatial people, with a nice display of these dashboards relating to the the most important subject in the past couple of years. How our industry, through these incredible dashboards with powered by big data. Let's be honest. 13 billion records in this first one. So I've gone from impressing you, hopefully, with how this industry, how humanity has come to call on this industry to help humanity understand and respond and control this pandemic. Funnily enough, side note, what is the main thing that humanity is trying to control to do with this virus? Well, it's the compounding rate or the exponential growth of the virus. And so how can you sort of gauge the potential compounding rate? How does this chart help us do that? Well, it's this. It's that you propagated, the people on this beach propagated across the country, and each route of propagation involved multiple contact points between people along the way. So there was a huge compounding potential for the virus in all of these routes away from that beach in Florida. So I thought that was a really curious parallel. How we're, and that's also another important point to bear in mind with compounding, is that it can go. There's negative compounding. Its effects can be negative. For example, spreading a deadly virus, or it can be incredibly positive. In both respects, the thing to pay attention to is that if you give it enough time, the growth rate will be astronomical, and the results will be catastrophic if it's about something bad, or incredibly good if it's for example the growth rate of the 3D mapping niche in the geospatial industry. So just to try and nail this point for you in another way, a bit more compelling way, using yet another dashboard or calculator in this case. I've got a compound interest calculator. Again, I will put the link for this in the show notes. It's a really useful one. So I'm going to say, you pretend. Let's pretend that we're a diligent, part-time, fairly hands-off investor. Someone who's taking a salary. That's the main way they get their income. But maybe they've heard it. They've watched this podcast and they've taken an interest in how they can, in a safe way, begin to dabble, dip their toes in. So say they're going to put 100 units of your local currency per month, let's say, into something that's just the market index. So as that chart said. So we're going to do it for 10 years, let's say, just to get a feel. So the market index was 6.7%, right? The market return, or the market index return. So let's start off with that. So we're putting $100 in a month. We're doing it for 10 years. We're growing it at the market rate. What do we end up with? So ultimately, we end up with $17,000. Cool. So we had. It looked like over those reports that I looked at for the whole geospatial industry, the growth rate, I'm going to say, let's be conservative, I'm going to say it was 11%, something like that. So we've got so we're going from 6.7% compounding rate, still just $100 a month, keeping everything else constant over 10 years. How much do we end up with now? Well, we go from 17,000 to 22,000. Okay, so that's cool. So obviously we got 4,000 more, 5,000 more, through bumping our compounding rate up from 6.7, the market average, to what the geospatial industry average could give us. So if we had an index of all of the the businesses in the geospatial industry that are on the stock market, theoretically. We could get, say, 11% until 2028, which is when a lot of those reports were projecting to, and suddenly we get more. It could be better to go in our industry. But then, if we paid a bit more attention, we just looked at the 3D city mapping or modeling niche. We went with so that report was 17%, but I did see another one, as I said, that was 21%. So let's sort of, go in the middle. Let's go for 19%. Over 10 years, $100 monthly, same thing. Whoa, My God. Okay, so we've gone from 17,000 if we just went with the index, and you can buy index funds, of the American market, the Australian market, the UK market, whatever one you want. You can even buy world funds, they all sort of compound, at least in the developed world, at about 6 to 7%. But so if you go from 6.7 up to 19, you go from 17,000 as the outcome over 10 years to 35. All right, so this is double, more than double. So, I hope that I think it brings home the message that there is a benefit in potentially that you as someone in the geospatial industry can get from by leveraging your training, your professional experience, your industry contacts and connections, and just observing how the entrepreneurs, the venture capitalists, the investors that have set up the business that employs you are behaving, and how all of the businesses interact, run by all of those entrepreneurs, how effectively those entrepreneurs interact with each other via their businesses in this geospatial industry. So I guess onto the last part, we've introduced you to the dashboards and how the industry benefits humanity. We've looked at the concept of compounding and how if you're just earning a salary, you're not really benefiting from the effect of compounding. We've looked at, some examples of compounding and how when you're 20 years old and you've got $1 in your pocket, by the time you're 65, that's actually worth $18. So every dollar in your pocket at 20 is actually $18 if you're allowed to compound. So we basically looked at, tried to drive home the point of compounding. I looked at compounding in the context of the geospatial industry, and we found that, basically it's something like, the pessimistic ones were 5%, but it sort of went up to maybe 13. I called it 11% just to somehow be a bit conservative. And then there are niches in and potentially star businesses dominating those niches in the geospatial industry that are growing way faster than not only the geospatial industry itself, but also the market. And those ones, that niche and businesses operating in that niche would be ones to look at further as an investor. So let's take this then to the next step. And we'll go to a website called TradingView, and you can see on the right, I've got a geospatial and surveying watch list, drafting and CAD. I've tried to sort of cover a bunch of different aspects of the geospatial industry and publicly traded businesses that are from the industry, and as a way to sort of see how we can, what would happen if we bought some shares in them. So let's start. Let's look at a couple of the more well-known ones. So we've got Trimble here, TRMB, and we've also got ADSK for Autodesk. So these are two really big dominant businesses in the geospatial industry. So Autodesk, I've got the chart starting in 2010. Pardon me. Let's maybe go to 2011. There we go. So around about the middle of 2011. There we go. That's the start of 2011. That's when I started my career. So Autodesk, this dominant big firm from America, I'm guessing. I should know that. We'll find out as we go through the different episodes of this podcast, and I'll do analyses of each of these businesses. So what's it done during my career when I've been earning a salary and I haven't owned any shares in any of these businesses? So it's gone up 4.8 times, 480% growth since 2011. Can I say that my salary has increased 4.8 times? No, it hasn't, to be honest. My initial starting salary in 2011 for GHD as a geospatial analyst was 65,000 Australian dollars. My salary currently in London as a principal geospatial consultant is not 4.8 times that value. So right there, I don't have to go any further. We have the dominant, probably most well-known, geospatial firm producing software that basically every single engineering firm, government department that does geospatial stuff, every construction company, every architect has this software. If you were going to enter the geospatial space in industry as an investor, you would definitely pay attention to this firm, and you would have done very well over the past 10 years. Let's look at Trimble, the other really well-known participant in this geospatial industry. So what have we got here? 2.8 times, 280% growth since the start of my career. Would I say that my salary has gone nearly 3 times? No, currently, certainly at some points in my career, it has definitely been more than that. When I was in the Middle East, where not only do you get high salaries, you don't pay any taxes. Some of the salaries I've been offered there, including ones I've turned down, have been astronomical. But in the broad scheme of things, where I am presently, with a decent role as a principal geospatial consultant, my salary still hasn't gone up 2.8 times in that past since 2011. So I would have been ahead, in terms of compounding in the market with these shares, compared to just benefiting from the more linear growth from a salary. So that's interesting. These are the big firms. Let's look at some smaller ones. And actually, a way to do that in TradingView is to compare them all here. So I'll turn them all on. So what the hell's going on here? Everything's going up and down. It's very hard to see really what's what. So what's the yellow? That's a company called Nearmap. So they started in Australia. They collect aerial imagery. They fly planes or rent planes and put cameras in them and get really high detailed imagery of the surface of the ground. You can see that one for a while killed everything. It did even better than Trimble. It was really going great, and then it sort of crashed to earth. Let's look at some others down here. So there's some really new companies. We've got the entire advance sort of starts in 1990 with Trimble. That's the one that seems to go the furthest back, although Autodesk goes even further back to 1985. It's really interesting to see, the history of these firms. But look at that. So that's another thing I didn't think of. So since 1985, since the IPO, the initial public offering of Autodesk, it's gone up an amount that you can't really imagine, 440 times, right? So if you just bought shares at the start and just parked your money there and left it, even through the great financial crisis, even through the dot-com bust, you would be up an incredible amount. But anyway, let's go to some more recent times. Let's see what's going on here. Let's go to, let's keep it at 2018, so the past 4 years. And what's the one that stands out? Well, it's this one here, IQG. What's going on here? How old is IQG? Well, it hasn't always been going that well, has it? So they started 10 years ago, actually. There you go. So if I put them from the beginning of my career, it would have been a bad investment. We would have been down 40%. But something's happened, in the past sort of 6 years, that's turned the business around. So let's just look, let's pretend that we only knew about them 5 years ago, or just around, to drive the point home. Let's put it 2018. All right, so this IQGeo is winning amongst the whole pack. IQGeo. What do IQGeo do? Well, I found out about IQGeo during a job interview with Swish Fibre. Basically, the largest privately funded engineering project in the UK at the moment is to push fibre to the premises or fibre to the home for 25 million properties across the country by 2025. It is a ridiculous task. The amount of design work, the amount of construction to do all of that. It's a team of tens of thousands, and it's a race basically for territory for all of these fiber optic companies to build fiber to as many houses as possible and sign up as many as possible. Why does that matter for IQGeo? Well, IQGeo are selling software for geospatial software that serves the network analysis and utilities niche. So they have a unique offering that basically solves the problems, reduces the pain that's unique to utilities businesses, for example, fiber optic companies, that are having to solve network and routing problems in order to earn money from their customers. So that's really interesting. We have a really hot space at the moment. Fiber optic is happening all across Europe. Germany, France, Spain, well, especially Germany, France, and the UK. Actually, Spain's quite far ahead as far as I understand. Or maybe it's France that's further ahead. Anyway, the largest countries in Europe, including the UK, are really far behind in rolling out fiber to the home. So there's a massive push on, bunch of funding, lots of private entrepreneurs. Again, that term that keeps coming up, that group of people that keeps coming up in this episode, are pouring money in. So it's a hot space, and we have a business that's done very well in the past 4 years that's leading the pack of these 10 or so geospatial industry stocks that is serving this particular niche, and they've done the best out of all of these geospatial businesses. So I thought that was a nice little effect and story to tell you guys, to begin to sort of investigate our industry that we know so well as professionals, but from the perspective of leveraging that industry for more than just for the salary that we can gain from it. We can use our knowledge, our contacts, our attendance at networking events, to look at the industry we're participating in from a different angle and consider ourselves as stock analysts, as business analysts, as industry analysts. And it turns up the volume a bit on our engagement with our work and our industry, I think, and we can get paid more for increasing our attention. So I think I've pretty much gone through all of the points that I wanted to cover. I'm sorry I wasn't maybe as sharp as I could have been, but I don't know. I'm really feeling some urgency about this, everyone. That's why I'm literally recording this past midnight on a work night. I'm just gonna get this out there. It's my second take. I tried on the weekend a bit of a shorter intro video, but I don't really feel like I covered everything. I think I've done a more comprehensive job here, whilst also hopefully keeping it interesting from the beginning to the end. So that's where I'll leave it. My sort of concluding remark is, if we go back to here, on the left, really, we have the first sentence of this quote. This is the mindset, the short-term sort of paycheck to paycheck mindset. Week by week, we take a salary, we buy things, we start from zero again. Let's see in this podcast. Let's see if we can spot the potential within our industry to switch over to the next part of this quote, to move into the investor, venture capitalist, and entrepreneur space and benefit from their work and their perspective, and move beyond just the salary-based gains that life offers, over to the right-hand side of this chart, where with some intelligence and using our knowledge, we can get on the right horse and have the patience to stay on it. and see where it takes us. Thanks.